Good afternoon, and welcome to Scotia iTRADE's webinar. Today's topic is managing risk in volatile markets with the market guys. My name is Conleaf Lyons, the Client Education Specialist with Scotia iTRADE, and I'll be your facilitator for the next 60 minutes. So before we get started, let's just take care of some quick housekeeping items, and then we'll dive right into the presentation. So you should be able to hear, but if you'd like to test your audio, simply click on the sound check link that you see in the audio panel there on your screen. And this may show up as a settings link, and this setup window may be on your secondary screen if you're using two monitors. Now, if you'd like, you can always call in using the telephone. Simply dial the number you see on screen or the number you see on your screen. Don't forget your access code and your audio pin ID. Also, too, you may wish to use the hand icon to signal if you've got any questions or anything, or if your sound is not well, you may just use the hand icon to let me know. As always, everyone will be muted for sound quality purposes as we go through the presentation today. Now, as a quick reminder, just some quick disclaimers. Unless otherwise expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, collectively called content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party products or services, third-party content, or investment loss arising from the use of any of the content, including the third-party content. The information that we're sharing today will be for general purposes only, informational and educational. It's not intended to provide any sort of personal investment advice, or doesn't take into account your specific objectives, personal, financial, legal advice. So just keep that in mind as we go through the presentation. We're only discussing things for educational purposes only. The other point, just to make sure we are aware that options do involve risk. They're not suitable for all investors, and they're not intended for sophisticated investors. So before trading options, please carefully review the options account agreement contained in the Scotia iTRADE relationship disclosure document and the terms and conditions. Now, I've put a link on the page here, but this would be found on our library page. You can just go into the documents there, and you'll find that there. If you don't have access to it, just email me, and I'll be able to provide that to you. That's education@scotiaitrade.com. Now, we'll also be able to use the toolbar from the GoToWebinar platform. The orange arrow you see at the top can be used to hide or to show the control panel. It may disappear from time to time. Just use the orange arrow to bring it back again. And you can always view in full screen mode by using that icon there you see on that little computer top screen. You can view in full screen mode. Now, we'd mentioned if you have a question, you can use the hand icon, but preferably if you just like to type in the question in the question panel box, that might be preferable. And our presenter will address them at that point or at the end of the presentation. Today's session will be recorded. Then we will email a link to you automatically tomorrow within, say, about mid-afternoon, around 1 or 2. You'll receive an automated link with the recording to today's session. Alternatively, you can always visit our YouTube channel. We've got webinars there on our Webinars on Demand playlist, so you can search to the archives to see if there's a webinar there you may want to go through. The other point then is that the presentation that we're providing to you today, I'll be providing a deck, a PDF deck at the end of the presentation. I'll be uploading that into the GoToWebinar panel. So once we complete it, just give it about 30 seconds or so, and you'll see that document there. You can then download that to your own computer going forward. Then you can link those with the recording that you get tomorrow. So today we have with us AJ Monte. AJ is the Chartered Market Technician. He's got over 30 years of experience in the financial industry and currently serves as the Chief Marketing Strategist for the Market Guys. AJ teaches professionals and novices alike innovative techniques to accumulate and protect wealth. Now, he's also one of the more recognized financial experts in the industry, thanks to his appearance on ABC, Fox Business, and PBS Television, as well as a regular guest slot on Serious Money Radio. 2 books. AJ is author of 2 financial education books and is known internationally for his financial educational seminars. So at this point, I'd like to welcome AJ, who will take you through the remainder of the presentation on this topic today. AJ?
Well, welcome everyone, and thank you, Conley, for that great introduction. You know, as I bring up my slide presentation here, I just want to point out to everyone that in the description and the introduction for my part here, I've been noted as being a person who creates ideas for accumulating and protecting wealth. Now, that is most important that you understand the protecting the wealth part of that equation. And that is where I'm going to start, because for me, this presentation with regard to managing risk is, in my opinion, the most important bit of information that you could learn about and know about. And it's something that I could not overstress, and some of you already know what I'm talking about. I could tell you by a show of hands. I can't see the audience for some reason. I don't know why I can't see, and I'm not able to see your questions. So Conley, if you'll have to field those questions for me. I know many of you who have been in the markets for any length of time have at one point or another lost money on an investment or a trade. And if you haven't gotten to that point yet where you've lost money on a trade, then it just tells me you haven't been in the markets long enough. Eventually that will happen. And if you are part of this educational series, I would also like to pay you a compliment, because the average person is not going to go out of their way to learn these concepts. The average person is working hard at their business or working at a job somewhere. They get tied up in the world. They watch television when they get home. They unwind. They might do some extracurricular activities, sports, whatever. But they're not taking the time that you are right now to expand your horizons and learn the proper way of investing. And so when I show this screen, this has nothing to do with lawyers or anything. I want to show you that the highlighted 1% rule for managing risk is where I want to talk to you about. That is my intellectual property that I came up with 35 years ago. And I want to tell you the reason why I came up with the 1% rule for managing risk. When I first started trading on the trading floor, I knew very little about investing or trading. I actually took a position as a page, a runner on the commodity exchange floor in the World Trade Center. And my degree is in aerospace engineering. It has nothing to do with finance. So starting from ground zero in a whole new world, I had to find people who could teach me the right way to make money and to protect my money. And in 1982, August 15th to be exact, I stepped foot on the trading floor, and I worked my way up pretty quickly to 3 years later. In 1985, they introduced options for the very first time on Wall Street at the commodity exchange, and I was one of the first people to ever trade an option. Again, knowing very, very little about investing. And so, to fast forward a bit, I took all the money that I had at that time, learned from the masters on the trading floor of how to make money. And true story, and I've written about this in my book, and I've talked about this on many television shows and radio programs. I took $2,000 of my own money and in 3 years turned it into $1 million. Now, does that mean you're going to do the same thing? Absolutely not. I don't know what your disciplines are. But to finish that story, after I had made the $1 million, I took a fairly large position in silver when silver was trading $11.50 an ounce, and without any risk management plan, continued to trade silver, and silver collapsed almost overnight. It actually took a few weeks for it to go from 11.5 down to $7.50. Now that's like the Dow Jones Industrial Average going from 11,500 to 7,500. That's how much of a dramatic sell-off it was in silver. And in a matter of weeks, I watched my $1 million profit literally evaporate. Now, thankfully, I was single. I didn't have a house at the time. I was more or less a Wall Street cowboy. But it was at that point that I made a decision to myself to hold myself accountable in such a way where I refused to allow the market to ever do that to me again. And so I came up with the 1% rule for managing risk. Now, it's a simple math formula that involves, and I could give this to you if you want to write this down. I did not put it in the slide because I really don't want too many people copying it. Like I said, it's my intellectual property. It's basically you deciding how much you're willing to risk of your money. That's called a risk amount, and I'm going to get into the how-tos of this a little bit later. But you take the risk amount and divide that by the risk per share, and that gives you the number of shares to buy. So it's a simple calculation. Risk amount divide by risk per share equals number of shares to buy. Now that is what I own. That's the intellectual property. And I call it the 1% rule because my risk amount that I'm willing to risk, and again, this is my own discipline, is I refuse to allow the market to take more than 1% of my total account from me at any given trade. So what this does, the formula that I've created in the 1% rule, it allows us, and you can follow my bullet points here, it allows us to move away from the emotion of investing and trading and allows us to be more disciplined, because now we're not relying on our ability to get in and out. We're allowing the formula, the mathematical formula, to tell us when to get out when things start going bad or start moving against us. Now, bullet point number 2, risk management allows for more losses. And you might think, well, AJ, I don't want to have more losses. Well, don't misread this. Having a 1% rule, allowing you to only lose 1% of your total account in any given trade, allows you the flexibility and even freedom to lose on more of a frequency, but still not lose a lot of money. And I don't want to confuse you on that, but that's the crux of what we're talking about here. If I have, let's say I have 10 trades that I'm making, and I have allowed myself to lose only 1% on each trade, and all 10 trades go wrong. I lose money on all 10 trades. Well, how much money or how much of a percentage will I have lost? If I've lost 10 trades in a row times 1%, I've lost 10% of my account. Now, 10% loss of your total account is something that you could recover fairly easily over time, and now I'm going to tell you, if you're losing 10 trades in a row, we're going to have to talk, because that means you have to polish your stock picking skills. But my point is, you could be wrong 10 times in a row and still not suffer a catastrophic loss. Versus someone who has no risk management plan back in 2000 or 2008, and the market goes through an extreme sell-off, a collapse even, and I've seen people lose 40, 50, 60% of their account value, and now it's taking them 8 to 10 years to recover just back to break even. See, that's not the way to go. If you want to make sense of all this and do it in a way that will allow you to sleep at night, then you follow the simple formula. That's really as easy as it gets. Now, the risk management that I'm going to discuss with you here today does require an understanding of technical analysis. That is the main tool by which we are using to get in and get some insight as to where the money is going and where the money is leaving, and what the trends are looking like, and it gives you an idea of who's moving the market and how much they're moving the market by. And so technical analysis is the main tool. And also, like I alluded to earlier, risk management does start with stock selection. So if you are tracking your progress and you find that you've, out of the last 10 times you've invested, you've lost on all those times, that means that you have to hone in and develop a better plan for picking stocks, which I'm also going to get into with you today. And also, finally, the risk management is not negotiable. And what that means is, if I say to myself, okay, AJ, I'm not going to lose more than 1%, and I am absolutely going to get out of this stock if it drops to whatever price I put out there, you cannot renegotiate and say, well, you know, it's down at that point where I'm going to get out, but, you know, I think I'm going to hold on a little bit longer because some good news came out today, and I think this could get me back to break even. No, that doesn't happen that way. If you say you're going to do something and get out at a certain price, you have to stick to it and hold yourself accountable. And if you could follow all of these points, I'm telling you, you're going to do very well on many levels, because it's going to help you remove the emotion so that you're not stressed out. See, bullet point number 1 on this slide, again, I'm almost redundant to the point where I'm repeating myself, so I make sure you get this. That's actually by design. I'm repeating over and over so you make sure you get this. We're programming ourselves now to think in a certain way, first of which is holding yourself accountable, because you're holding to a plan that's going to allow you an escape hatch, okay? Selling is predetermined. Like I said before, if I'm saying to myself, okay, if the stock gets down to this price, I'm out. No matter what happens with the stock, no matter how much good news comes out, I'm out. Again, you're not making that decision at the heat of the moment, and therefore, again, it makes it a lot more comfortable for you to stay in the markets. Now, losses are also kept within your risk tolerance level. I'm not saying that you should develop a hard shell so that you're immune from the feelings of losing money. No, those emotions are good as long as that the emotions are not interfering with your snap decision to get in or out of a stock. And again, a little redundancy there, but intentional. Now, it's going to be your emotions that are the greatest enemy. At the last slide, I do believe on this, I'm not going to jump ahead here, but I do believe that on the last slide I talk about your investing your time in education like you are right now, going through the Scotia YouTube television channel, going through these webinars, listening to recordings. That's time that you're investing to gain more knowledge. So it's not your lack of knowledge that's going to get you in trouble. It's going to be your emotions that get in. So as you learn and you decide you're going to follow on this path of education, just keep grounding yourself back to this presentation, because, again, it is the most important part of investing. Now, another thing about keeping the losses small, it's actually easier on your account as well, because if I'm only suffering a 1% loss one day, I look at another stock, I might get out of one, take a loss, get into another, and thanks to the volatility in the market, it's not going to be hard for you to find another candidate to get back into. So what I'm saying here is there's a big mistake that a lot of people make, in that if they suffer a loss in one particular stock, whether, again, they're a trader or they're an investor, a lot of people jump right back into that stock in an effort to try to make back the loss that they first realized on that stock. And let me tell you, this is not a football game that we're trying to beat our opponent. That stock is not your enemy. You're not going to overcome and beat that company the next time around. What I tell people is take your small loss and then go, using your stock selection skills, go find a better stock to invest in, and now look at that next stock investment as your way to make money, and not chase the loss. Again, a lot of people, because they're so success-minded, they feel that they have to overcome that loss and beat the market. No, that's not the way it goes. Just let it roll off your back, get right back into the market, do your homework, and look for the tools that will help you find those stocks, and then use the charts to be able to pick the right timing of that all. Now, again, loss aversion causes us to hold on to stocks longer. Remember what I said, we're not asking you to develop a hard shell so that you're able to take a loss and feel okay about it. No, let's just stick to the numbers and we'll go from there. Now, these 6 points are actually taken from my book. It's a modification of the 5 points for trading success, which is a best-selling book out there that is, it kind of reads more like a textbook than a novel. And these 5 points are what I've developed, again, over the years, 35 years now, that I find is more like a recipe card for you being able to step forward and do it with confidence. Now, in my classroom courses, I teach on a college level. I actually teach virtual courses to high school students where this type of curriculum is just not found anywhere. I more or less come across as a teacher, and I tend to teach in pictures. So as you'll see, sometimes I'll use some cartoon characters in there as well to make the point, but try to open up your mind to the pictures that I create for you, and then take those pictures and plug them into these steps. In fact, if I have a student that basically wants me to teach them how to trade the market, what I do, even before I hand them this recipe card, is I actually give them an email that has a document attached. Now listen to this. You want to do this for yourself as well. It's a document that they sign to and for themselves. It's not any kind of a legal contract or anything like that. What I do is, and I'll give you an example, it'll say something like, I, underline, fill your name in, I promise to follow the risk management rules so that I will not allow the market to take more than 1% from my account in any given trade. Now, writing it down and holding yourself accountable, it might sound a little silly, writing yourself a contract and then signing it. But I do not go even to the first base or even to the first page of any presentation until I know that person has committed to themselves to hold themselves accountable to managing risk. This makes everyone happy. It makes you happy because you know you're relying on a formula. It makes the brokers happy because they're doing their job to help you protect yourself against yourself in a bad decision. It makes me happy because I know I'm getting traction and helping you better. You see, so everyone wins. It's a win-win when you follow the rules. So in the first part, again, hold yourself accountable, promise to yourself that you're going to hold to the 1% rule, and then you go through 1, 2, 3, 4, 5, 6, first of which is identifying the market and segment trends. Now, Conleaf, again, I do not see any questions coming up, so I don't know if you have any. Folks,
yeah, no questions yet, Clayton.
Okay, if you do, cut me off, and I'll take the question. You could just read it to me. You could field the questions. Okay, and then in the end, if you have questions, I'll give you my email address so that you could send me those direct, and I'll get to those, especially if you're listening to the recorded session. Obviously, the people who are live right now, again, have the ability to type in a question so Conleaf could read that to me. Okay, so identifying the trend. What is a trend? What is that? Well, basically, it is the movement of money in either an upward direction in price or a downward direction. That's all a trend is. Now, there are also times when trends move in a sideways direction, but the important thing is if you're a buyer, this as though you're looking to buy an exchange traded fund or a commodity. I'm treating it from the buy side now. If
Okay.
you are looking to buy into a stock, you have to first make sure that the trend has been going up in that stock. And what that tells us is the money is moving in to the stock. Now, once you've found the trend, you then have to develop a skill, and Conleaf is going to show you how to do this when we flip to the live presentation through the FlightDesk. You'll develop the skill of knowing how to draw a simple line on the chart. Now, most of the lines that you see me or Conleaf draw on the chart, most of them are going to be simple horizontal lines. And the horizontal line that I encourage people to draw is this. The blue dotted line represents what's called roll reversal. Roll reversal. This is a pattern, and I'm using more or less like a stick figure textbook model of what it looks like in a line chart. But this one little pattern is what made me my first $1 million. This learning how to find this on a chart helped me increase the probability of making money dramatically. Now, again, what this does is not only helps you find the right entry point, but that dotted line will also help you with your exit strategy should the stock move against you, okay? And I'm going to describe this for you again. Once you find that roll reversal, and let me see if I could draw this for you. Let me draw the pen. And what color pen color should I use? I'll go with blue. Okay, so right here I'm going to draw a little letter R representing resistance. Okay, so you can see that the stock had gone up, it hit resistance, which is where the sellers start to come in. The stock pushed down, it went back up again, and you see I'm going to draw another R. It hit resistance. So on this side of the line, that is resistance. We see that. Think of it as a ceiling where the sellers come in. But at this point in time right there, what happens? The stock breaks out over the ceiling, and the sellers are no longer able to keep the stock down. So that is a point called the breakout where the supply and demand shifts. At that point of the breakout, there is now stronger demand for the stock than there is supply. Now when this happens, when the stock breaks out right at that point, what happens is the former resistance, once broken, turns to support. And what we're looking for at this line is a V. You see that? It's called a pivot point. We're waiting for the V to form before we actually get in. So in searching for these roll reversal points, what it does is it allows you time, actually. You know, you have the luxury of time. You could be patient. You're waiting. It's kind of like you're fishing. I don't know how many people have gone fishing before, but let's face it, we don't fish with a baseball bat, do we? We'll chase all the fish away if we try to fish with a baseball bat. So instead, we wait for our moment. We put the bait out. We watch. And with patience, while keeping that line in the water, eventually we'll get a bite, and then we'll strike. And that is how you increase the probability of making money, by not just randomly selecting stocks or listening to the next talking head on one of the financial networks. You're actually going to wait for the stock to come to you. So now once we have identified that pivot point, and we know that we're buying in that particular area, we now use this support line here. Okay, we use that support as the barrier that protects us, and that's how we set our stops. So if you are looking to protect yourself, I know some stocks you're in Canada, you're not able to put a stop loss order, but you can use a price alert. And in fact, again, Conleaf will show you. Conleaf, please remind me to show everyone how to set up a price alert on the FlightDesk platform. So what I mean here is if you buy the stock and then all of a sudden, the stock starts going down below the line, you have to then revert back to your risk management plan and say, okay, I'm out. The stock didn't go up like I thought it would, so I'm going to get out. I'm going to take a very small loss, and I'm going to move into the next best stock. So the area of what we call the stop range is going to be at a price range somewhere below that support. Again, follow the steps, and remember, you're going to get a copy of this presentation at the end. Just Conley will guide you to the download point. When you download it to your computer, again, you have my full permission. That's my gift to you. You have my full permission to print out the checklist so that you now have that recipe card in front of you so you know how to follow the steps to be able to put the odds in your favor. Okay? Now, again, this is what we're looking for, the horizontal line. We're waiting for a pivot point, but now we start to get into the formula. Remember, I told you, this is the intellectual property of the market, guys, and a simple math formula. Here it is. It's only 3 steps. There's only 3 steps to this rule. One is to determine what 1% of your account value is. Now, in this example, I rounded it up to $100,000 just to make the calculations very easy. But you might be only trading with $5,000 or $10,000 or maybe $150,000. It doesn't matter. Whatever your trading account value is where you start at step 1. Whatever the account value is, you calculate what 1% of that value is, and that, my friends, is what the risk amount is all about. The risk amount is what we are going to plug into that math formula to tell us where or how many shares we're going to get to buy. So step 1, again, is to calculate what 1% is. Now, see my blue note right there? This has nothing to do with the share price. So it's not like, okay, the stock is trading $100 and I'm going to let it drop 1% to 99. No, it has nothing to do with the share price. This has everything to do with your account value. Please understand that's, again, a very simple math formula, but use your account value to calculate that. Now, step 2, and again, if you have questions along the way, type them in. Conleaf will get those to me. Step 2 is to calculate what your risk per share is. Your risk per share is going to be calculated by looking at the chart. You see, it's your entry price, right? So remember what we were looking for. We were looking for a pivot point, and somewhere within that pivot point is going to be the area where you're buying that stock. So we take the entry price and we subtract the stop price, the price at which we would get out of the stock if it goes against us. So the difference between those 2 numbers is equal to the risk per share. Again, I'm almost talking to you like an elementary school student, so forgive me for that. I don't want to be condescending in any way. I just want you to get this, because this is how for the past 30, let me see, it would be 31 years. For 31 years now, I have not had a losing year. I've lost on individual stocks, but for 31 years, I have not had a losing year because I use this simple calculation. I'll lose on stocks from time to time, but in the end, picking the stocks and setting the risk points is going to be the secret that helps you be successful, really. So let's look at the chart to show you how, again, to calculate the risk per share. Let's say we found our horizontal line. That's the role reversal, right? We got that. And now what we do is we decide we're going to buy the stock. Now, in the example here, we're buying the stock at $45. Now, let's say we're just buying 100 shares. Okay? We don't have to go crazy and buy thousands and thousands. Let's just say we buy 100 shares. I'm spending $4,500 on that trade. But how do I know that buying 100 shares is going to be right? See, I may actually get to buy 200 shares or 300 shares. See, just because you can afford to buy the stock at $45 doesn't mean you need to spend all of your money on that trade. See, so the 1% rule helps you calculate the proper amount of shares you should buy. I'll bet you never heard that before. How many of you turned on BNN, listened to one of the stock forecasters, and they say, okay, we think the stock is going to go up, but we think you should only buy 100 shares of it? No, they never say that. They just give you their opinion, and a lot of times investors follow these folks like sheep. And the second part of that story is they never call you up and tell you, hey, we're getting out today. They only tell you, hey, we like it, right? So they give you that recommendation on television that they can't follow up with. All right, so I buy it at $45, and I see that I want to put my stop loss order somewhere below support. Now, again, as an example, I selected $43. That is the point at which I'm going to get out. So what I'm basically doing here is I'm allowing that stock to drop $2 against me before I get out. Again, the difference between the buy price and the sell price is the risk per share, you see? And that is the second part of the equation that we plug into the formula, right? Hopefully you got that. If you have a question on that, stop me and we'll go. And what I'm going to do at the end, I'm monitoring my time currently. If we still have 24 minutes left here, we have a lot of time. I want to take some stocks that you're looking at. I'm not going to tell you what to do with the stock. I'm just going to show you where you would plug in the formula and looking at the charts, and then you could do the rest. But the step 3 in the formula is we take the risk amount. Remember, in the example here, the risk amount is going to be $1,000, right? That's what we're talking about there. And the risk per share is what we just calculated in the $2. I'm allowing that stock to go $2 against me. So if I'm willing to risk $1,000 and I'm willing to let that stock go $2 against me, I am only able to buy 500 shares to stay within those parameters. You see? Now, if you had a stock that was $90 instead of $45, well, you could still use the same formula. If I'm buying a stock that's $90 and I'm allowing the stock to go $2 against me, I could still only buy 500 shares. I could buy less. I could buy a little bit more, only if I move my stop. And I don't want to confuse you here, but you could adjust. You could also adjust the number of shares by changing the risk per share. I could put, instead of a $2 get out point, I could put a $1 get out point. So let's change the formula here and let's see who comes up with the right answer. Conley, if you could highlight the first answer. If I'm allowing a $1 risk per share, so I'm buying the stock at 45 and I'm getting out at 44, and that risk per share is 1, how many shares do I get to buy now? Well, if you're doing the math properly, Conley, if anybody answer that, it's a pretty easy question.
Yes, we've got Robert here with 1,000.
Exactly. So we take the $1 risk per share and divide that into the 1,000. So now I get to buy 1,000 shares. See, but the ability for me to buy 1,000, something has to give. I'm willing to let the stock only move $1 and not $2. So you're giving the stock a little less room to breathe, but at the same point, you're still limiting your risk to 1%. Okay, hopefully you get that. It's very, very easy. You'll have to practice it, and I hope you do. And this is what it would look like. Now, I have another test question coming up. It's a little quiz question, okay? But you can see here from this chart that I have already drawn some of the role reversal points. Again, here is an area of resistance. The stock went up, it came back down, it bounced off of support. So if I bought the stock anywhere in this area, I would put my stop somewhere below support. Again, here's an area of resistance, stock broke out, it bounced, boom, support. I'm going to put my stop somewhere below there. Now look at this area right here. Hold on, let me clear the chart there for a second. Look at the area where I have the question mark. You see, I am telling you that right here we see a role reversal forming, but what are we missing at this area right here? Why do I have a question mark? Well, because the stock never bounced. We never got the pivot point off of that role reversal. Therefore, you should not be in the stock at that point. Hence the reason for the question mark. You see, if I had gotten the bounce or the pivot point, I would have then set my stop below support, and at that point I would have been stopped out. Okay, now if this were the most current chart that I'm looking at, I see resistance again, it breaks out right here. Again, example, over and over again. I get the pivot point, I buy the stock here. Where am I going to set my stop? Boom. It could be $1, $2, $3. I don't care if you put the stop $10 below the stop price. If I set my stop $10 below, my risk per share is 10. I can do that. I can absolutely give the stock a whole bunch of room to go against me. But if I put my stop 10% below or $10 below, what happens here? My risk per share changes to 10, right? Now, how does that affect the formula? 1,000 divided by 10 means I only get to buy 100 shares. See that? So you can actually let this stock move way below support. You just have to sacrifice something, and the sacrifice will come in the number of shares that you get to buy. That's really as simple as I could make it. Now, a lot of people come to me and say, well, AJ, why do we see so many role reversals on the chart? In fact, what causes the role reversal to begin with? Well, it's actually very simple, and I'm probably one of the only ones out there that's actually regularly talking about the role reversal. If any of you follow me online through my market reports, you'll know that every single report I put out, I talk about support resistance. Every single one. Never fail. And what I do in my effort here is to educate the general public. Now, keep in mind, we all do much, much better as the audience grows to learn about this concept right here. Why is that? Because the more people that follow it, the more reliable the signal becomes. Watch this. See, initially, and let me try to draw the, I have to keep flipping back to my pen here. Initially, this is the area of resistance. You see that? Stock goes up, sellers take over and push it down. So there's the resistance. Then all of a sudden, the stock breaks out. Now, there are a lot of what we call day traders. There are swing traders that also will take advantage of the breakout. But what happens is when a stock breaks out of a most recent high or resistance point, the whole dynamic of the market shifts. Remember what I said before. Demand overtakes supply. So what happens is the stock, after the breakout, tends to run up because people are jumping in at that point, particularly the short-term traders. So they run the stock up, and they run it up, and then all of a sudden, those very same traders say to themselves, well, I'm happy with my $1 profit or my $2 profit or whatever it is. So because their strategy is short-term, what happens is they start to sell their position to realize and take their profits. So it's the mere action of these people taking the short-term profit that pushes it down. Then some people will take the profit at a high. Some people will wait a little bit longer, and they might even let the stock drop because they think, okay, it might go up again, but I'm going to hold on. But then, again, they second guess and they say, well, I'm going to get out. And then what happens? People continue to sell right up until the blue line is reached. Now think about this for a second. It should make common sense to you. The people who buy in here are pushing it right back down to their original buy point. You see? and then if we get the bounce, new buyers come in and do it all over again. See, there is a very large community of people that will, instead of buying exactly at the breakout, they will wait for the bounce. And if you think about it, both of these people, the day traders and the swing traders who are waiting, they're both pretty much buying at the same price level, except the people who are waiting for the bounce have a higher probability because now they have a place where they can guide and manage their risk. Remember what I said. If they buy it on that pivot point, they have a clear place to get out, whereas these people who bought on the breakout don't really have a very clear place. They're kind of winging it and hoping that they're going to make some money in the process. Okay, now once new buyers come in, you will actually see the volume be affected. It's pretty amazing here how volume is affected, and I'll show you what that means. By the way, you don't have to do this by the computer. You can do this manually, and that's called trailing the stop. If the stock goes up with each and every new roll reversal that's formed, okay, so let's say here's a roll reversal, here's a roll reversal. If the stock goes up and breaks out, it could be a new roll reversal up here. What happens is, what you do is, as the stock goes up, you move your get out point higher and higher. It's kind of like if you were climbing a mountain, you're going to keep moving your cleats up the mountain and hooking your rope in as you get to the higher levels. So that's called trailing the stop. You can do it manually. If your trading platform allows you a stock that does allow for stops, you can do that through the program as well. Now, another way to, I guess you could say, manage the risk, because obviously that's the point of this whole presentation, is to use the moving average method. And this still will require using the 1% rule, but what's happening is you're using that 20-day moving average as your guide. Instead of relying on your own ability to draw a horizontal line, an easier way is to simply move your stop or set your stop somewhere below the moving average. Okay, so if, let's say, you buy the stock right here at what is it, 23, so you buy the stock at 23, you put a $2 risk per share somewhere at 21, again, so your stop point is $2 lower. Again, your risk per share is $2, so you buy 500 shares of the stock at 23. As the stock moves up, you keep moving your get-out point along that moving average. You see what happens there? And then when the stock eventually closes below that moving average, you'll then get stopped out at the higher level. This method is something that allows more flexibility to the upside and allowing you to be able to make or lock in more of a profit. So again, it gives you that flexibility, but remember what I said, whether you're using a horizontal line in the roll reversal or you're using a simple moving average, you apply the 1% rule to that. Now, I alluded in the beginning, I alluded to the fact that we are looking at these stocks as though you're a buyer and trading the markets from a long position. But there are going to be some people that short sell. And I'm not going to spend too much time on this. There is also going to be people that are going to look to make money on the way down through inverse ETFs or contra funds, whatever it may be. But the whole 1% rule simply works in reverse. And what I mean by that is that if you're selling a stock short, you're looking to make money on the way down. So you might sell your stock at a certain point as it breaks down below that moving average. So support reverses its role into resistance. Okay, I'm going to give you a clearer diagram for that. But you might be selling the stock short to make it go down. So you're going to be putting your stop loss orders above the market, or you're going to be setting your alerts above the market. That's all I'm going to spend there. If you have a question on that, again, email that to me, and I'll be more than happy to elaborate on that point. But I want to save some time and be able to go to the charts. Okay, in review here, Okay, the rules are simple. You don't have to rush the trade. Be patient. Remember, I was talking about fishing. You put your pole in the water, you wait. Don't be impatient and try to force the trade. You're going to wait for the volume to drop just before the pivot point forms. And I talk about price and volume in other presentations. And you absolutely want to wait for the pivot point. Please do yourself a big favor. Wait for that. And one other little tidbit, although it's not part of a checklist, it's just a general suggestion. It's always a good idea to wait for the last 30 minutes of the trading day before you place your trade. And the reason for that is institutions generally adjust their portfolios at the last part of the day. There's an old saying that the amateurs open the market, but the professionals close the market. That is true. So you're going to get the clearest signal towards the end of the day, and you won't be subject to the volatility throughout the whole day versus you're putting your trade in the beginning. And again, remember, you're going to set your stop or price alert immediately below support as soon as you get into the trade. Very, very important that you watch that. Now, next steps, you're already doing some of this. Keep plugged into the webinars and live events. Invest in your education. Go out there, buy books, CDs, try to expand that. I always tell people investing in education is a risk-free investment because you're always going to get a return on the information that you learn and building your knowledge base. On the TMG library, I think I have a slide in here. Here it is. On the Market Guys website, I have a link. I don't know what that brown thing is. That looks like an error there, but look at the arrow. I have 2 videos that are directly related to what I'm talking about right here. If you go on the Market Guys website, these are all free, by the way. It's a free public library. These are very, very short videos. I keep them short intentionally so you can get the repetition. First is a role reversal. Again, and the reason I tell you to go that first is because the role reversal is what you're going to use in determining the risk per share as you use the 1% rule. So go to the Market Guys website, review those 2 videos. Combined, both of those videos are only going to take you 15 minutes total time. So it's a good review for you. And then because they're about seven minutes long, and it's something you could do on a lunch break even. And then, like I said before, if you have a question, even if you're listening to the recorded session, just send me a question to the Market Guys and type in the subject line, just type in risk management. Risk management will let me know which topic your question is pertaining to, and then we'll be able to go from there. I'll be able to help you. So, Conleaf, if you can take control back and open up the Scotia platform, the FlightDesk, we're going to actually have a good time here. Again, I cannot see your question, so Conleaf, you're going to have to field for that. Who would like to be the first one to volunteer a stock symbol so we can first find the role reversal? It's on almost every chart you can find. Who would like to do that?
Okay, Robert's got AGT.
AGT. Okay, Robert, thank you for volunteering that. Now, remember, following the checklist, we're going to look at the trend. We're going to look for support. We're going to look for pivot points. Now, unfortunately, Robert, on this one, the trend is going lower. Okay, so if I was looking for a buy candidate, I would be very hard-pressed to find a reason to buy this one. However, I do want to identify the role reversal for you so you can see how this works on the downside. Now, first, Conleaf, if you can go all the way, we're just going to draw a horizontal line, and if you could show the audience how you draw your lines, that would be good. You're right-clicking on the mouse, I believe, to draw up the tools, and you could draw a horizontal line. See, just as easy as that. So if you can go back to the first week of July, all the way, go up a little bit in July. First week, there's an area of resistance. Keep going a little bit higher, right, a little bit higher, right there. Boom, dropped the line right there. Now, you see, back then, there's an area of resistance on the first trading day of July. There it is. See that? So Conleaf is taking his line. He's drawing this now. He's drawing to the right from that high, and he keeps going a little bit further, and he sees there's a pivot point. You see that? There's the role reversal. So if you were buying this stock back then, you would probably buy it for around $36, put your stop $2 below, maybe around 34, and you would trail your stop up. And you can see that you could even trail it up with the moving average. There might have been a time in November where you have gotten stopped out. So there's the role reversal and how it would work. Now, on the downside, let's go to December, the low in the first week of December, the low right there. Let's draw a horizontal line all the way across into March. You could see, keep going, keep going, keep going. Right there, boom, drop the line. You see how former support, once broken, turned to resistance almost to the penny. So if you were short selling there, you would put your stop above the market. Now, Robert, again, I'm not going to give you my opinion on what I think you should do with this stock. I'm just telling you that it is in a downward trend. It's obvious to all of us it's in a downward trend. So if you're looking to increase the probability on any stock, whether it be this one or another one, you're going to wait for it to break out over resistance, form the pivot point, get that role reversal going, and then trade it from that way. Okay, thank you for that. We have 4 minutes to analyze another stock. Who wants to be the next one to do that?
Ken has H8.
H-A? H-A. Let's type that in. And that is...
I'm not familiar with that one.
H-A.
Yeah, Ken, I'm not sure if that's a full symbol.
Okay, let's go.
John, yeah, another one. John has DSG.
DSG. Let's take a look at that one. Remember, as my checklist implies, looking at the trend. Oh, beautiful. Look at that. Upward trend. How nice. This is textbook to what I showed you. Now, let's go through the different points. I'm going to point out the role reversal to you. Conleaf, look at January, the high in January of this year, and draw the horizontal line from that high right there. You know, it's amazing, folks. Conleaf is 1,300 miles away from me, and he's guiding this like it's my own hand. It's really, really great. Thank you, Conleaf. And Conleaf has been following along. He knows how to do this, just like any of you can learn how to do this. This is really a very, very simple way to identify your points. So there, we're drawing the line at resistance all the way across, and we are finding that that resistance, once broken, turns into support right around 30. You see that? So you could, let's say you buy the stock at 33. You could put your stop below that line, or we can draw a role reversal a little bit higher. Let's draw one in May. Let's draw it right at $30. There's a high in May right around $30. A little bit higher. That's April. Go to the right just a little bit to the right. There we go. A little bit higher. That high right there. There we go. Draw that horizontal line from that high. There's former resistance broken, and now look at this, folks. The support level in the role reversal matches up perfectly with that red line, which is the 20-period moving average. So as an example, if you bought this stock at, let's say, 34, and you even pay up higher than where it is now, you see that there's a little bit of a pivot point there. I would like to see more of one. But if you bought it at 34 higher, the pivot point would be intact. And then you put your stop $2 below, so your risk per share is $2 per share. Using the 1% rule on a $100,000 account, you get to buy 500 shares. See? It's very simple. So I certainly have not run out of content today. I've just run out of time. Folks, like I said, this is the most important topic that you can learn, by far. Learning the skills and how to draw horizontal lines like Conleaf did, or how to add a 20-period moving average like Conleaf did, those are skills that you can learn on your own time and then you start to apply that. What I would encourage each and every one of you to do before you start putting money at risk is I would practice. Conley, could you show everyone how to go to the practice page? I would practice on a demo account or a paper trading account. You don't have to actually put money at risk at first. Practice, practice, practice with, I would call, make-believe money. Learn how to draw your lines and say, okay, on this day I'm going to buy this stock, and on this day I'm going to put my stop, and then let it play out. Okay, so Conley, just take it away, and then I'll give it to you to close the session. I just want to show everyone how to use the practice session. Go right ahead.
So actually, AJ, there was one question from John earlier on. John had asked, what if after the stop loss is hit, jumps up right after, and we're left with a loss? How do you set the right stop loss based on what?
Well, John, if you get stopped out, you should actually celebrate that, not regret it. And that will happen. A lot of times, the stock will stop you out and then go up after that. That tells me two things. Either one, you put your stop too close to support and not far enough below support, and the other thing is the stock could just be that volatile stock that just has so much price action that it's hard to find a support level for it. So what I would do at that point is just fine-tune the stock selection process to give you stocks that have a more stable chart, like the one we just saw. That nice steady upward trend is the type of stock you want to look for when you're using this method. So hopefully that helped you and all the others that might have been thinking about that. Conley, thank you so much. I had a good time today. I hope you did too.
Great. Thank you so much, AJ. That was very, very informative. We really appreciate that. So I'm just going to wrap up quickly. We're just a little bit over time. So what's next? As mentioned before, our webinar recordings can be found on the YouTube channel under the education at scotiaitrade.com. After you exit the webinar today, a short survey will load as per normal. Just ask that you take a look at that, and if you could just give us any comments you have. If you would like the session today, we'd love to hear that. If you have any other ideas as to what other topics we can provide, that would be great as well. And if you have any other questions, you can simply email them to me at education@scotiaitrade.com, or you can email them directly over to AJ at the Market Guys. Coming forward on your calendars, sharpen your skills. Horizon ETFs will be providing a webinar, Covered Call ETFs, on Thursday, June the 13th at 1 p.m. And then shortly after that, on June 20th, Pro Market Advisors will be providing a webinar, My First Stock Trade. And this will be geared towards those who are just starting out. My First Stock Trade, Tuesday, June 20th. Now, for these and any other webinars, just go to our education tab on scotiaitrade.com, click on the events calendar, and you can register for any of the webinars that you find of interest to you. And go to the YouTube channel as well if you want to have any other archived webinars. So on behalf of Scotia iTrade client, the client education department here, I'd like to thank AJ Monte for an amazing presentation, and I'd also like to thank you, our listeners, for being with us here today and for supporting us. We appreciate that, and we look forward to seeing you again the next time around. Thank you so much. What I will do now is I will upload the deck into your go-to platform so you can download that. So bear with me just for a few seconds while I do that. Get the right one here. Okay, it'll take just a few more seconds and it'll be complete. Voila, it is now ready for you to download. So we appreciate that. If you have any other questions, feel free to email us and we'll be able to contact with you and resolve them. Thank you so much. Have a beautiful day.